Welcome to the Daily Update, where I'll go over the action in the market for Monday, April 17th, and then we'll see how things look for Tuesday, April 18th. We had a pretty good up day. We saw some late day strength. The early part of the day, prices were just chopping around sideways. We ended up falling lower, but then as the day went on, we saw prices rebound and actually close positive for the day. We're still looking overbought both in the short term and intermediate term. We have some pretty significant overhead resistance above where we're at right now. We're also seeing volume below average. That's always a concern. So we're wondering, is the market starting to get a little tired here? But we are still positive overall. Before I get going, please be reminded at the end of this week, on April 22nd through the 14th, I will be traveling. I intend to post the video every day, so stay tuned for that, and I'll do the best job that I can. I also have a podcast. Both in the videos and in the podcast, there is a PDF of all the slides and charts that I do use in each one of these videos. I do have a private Facebook group that you're welcome to join, and there's a new poll up. A number of you have already voted. And if you have any ideas for questions or things, I've kind of just been putting the same questions up over and over. Please feel free to let me know about that. Let's go back and talk about what happened. Right at the open, we had a flat open with prices staying near the unchanged level, which was just about at the daily pivot at 41.38. As the day went on, we started to drift lower. We got down to the 41.25 level. We found support. We bounced up, came back down, and then we moved back above the unchanged level and the daily pivot. We rose up above 41.50 and then closed at the high. We were up 0.33% on below average volume, another concern. So our technicals are still positive, looking a little toppy still. We didn't really do much to continue working off the overbought situation that we already had. If we do start to go a little bit lower, I'll be constantly watching things to see if we're shifting from a positive stance over to a more negative stance. Inflation and interest rates are the real fixation of the markets. We do have earnings that are coming out now, and then any Fed speak that we may get. There was a little talk about the debt ceiling that I'll discuss here in just a moment. And then we're wondering, is there going to be more banking information that comes out? Here's the intraday chart showing how we had a flat open. Then we drifted down to the 41.25 level, tried to bounce, came back down to it. And then this is where the strength came later in the day. So you could say that that's a little more positive, since this is when the professionals are actually taking the market higher, and we closed at the high for the day. Here's a look at large cap growth and value, showing how they pretty much did the same thing, with value actually doing a little bit better than growth. Here's the closing value showing the value was up where growth was down. It also was down for the mid caps as well as the small caps. Monday's session was more of a value play rather than a growth play. Here's the intraday chart showing on Sunday afternoon and evening how we were going flat to slightly higher. Then we started to chop around in the overnight session. We eventually opened up pretty much near the unchanged level, danced around a little bit, went lower with the cash prices, and then here's the late day strength. We closed at the high, and so far we've been drifting sideways in the initial overnight session. What are some comments that we can make? House Speaker McCarthy came out and said he thinks he has the 218 votes that's needed to raise the debt ceiling. The market kind of liked that, but there's a lot of gotcha, what about this, what about that going on. This proposal will have strings attached, such as spending cuts in exchange for the raising the debt ceiling and the little political posturing that really goes on when these things happen. So it would be very unlikely to pass the Senate. Volume continues to be below average, and that is a concern, especially on up days. On a short-term basis, we have our moving average study. One of those charts is looking a little toppy. The stochastics, the CCI 14, the Stoch RSI, and the Williams percent are. Intermediate term, still watching that TTM squeeze, the PMO study, and the Sean trend meter. The dollar was up as well as interest rates. And this home builders ETF negative divergence, we're still keeping an eye on that. I was going to drop showing that chart, but there's some things that are still kind of working their way out. But it is becoming less relevant from the blatant signal that we were seeing about a week ago. The 30 to the 5 is not inverted where all of our other yield curves are inverted. Sentiment is positive. We ticked up to 70 where it had been at 67. Our trend is positive, but it is weakening because the green line continues to go down even on an up day. However, When you look at the ADX, it's above its moving average, but it's still below 20, so we're more in a trendless environment. Even though we had the up day, I've kept the bias at mixed. I like the late day action. That shows some real strength, but we're not seeing an awful lot of enthusiasm right now, and I'm keeping our momentum currently at mixed. The economic reports that came out, we had the Empire State Manufacturing, which came out at 10.8. They expected it to be down 19. Last time it was down 24.6, so that was much stronger than expected. And the NAHB Housing Market Index came in at 45 as expected, one tick up from the 44 we saw last time. Looking at some Isabel Net blog charts, the one area that we're seeing a real contradiction right now is that earnings are coming down, but forecasts continue to be pretty optimistic. But the blue line is what earnings are actually doing. They still see them coming down. And then after that, they're projecting them to go back up. Also, at Goldman Sachs, they're kind of rosy with their outlook. They're raising the estimates from $222, to give you a nice round number, up to $224 in spite of what's happening right now. But they see the S&P actually going down and closing at 4,000. And then going off into the future, they also have a pretty rosy outlook. This chart shows short interest as a percent of market cap in the S&P. These are the people that are actually short the S&P 500. They sold to get in, and when they go to close out their position, they'll have to buy to get out. When you're dealing with an index, and especially when you're dealing with stocks, you want to have a pretty high level of short interest. Now, that may go against logic, but think about it this way. Remember, they sell to get in, so that pushes prices down. If a stock or the market turns against them, they have to buy to get out, and that's what we call a short cover rally, with a whole lot of shorts getting out at the same time, pushing prices up and up and up and up and up. The higher this is, the more there's a built-in set of buyers on the sidelines, and it's right about what it has been as of late. Now, there are other instruments that you can use. Put options, there are inverse ETFs, and even inverse mutual funds that you can use to play the downside. But there are still a lot of folks that actually go long by buying all their shares, and they go short by selling all of their shares, hoping the market will go up or down. This looks at U.S. real rates. That takes inflation into consideration, where they really spiked up, but they have been coming down lately. This chart is the same as what I showed over the weekend. This is the latest reading from GDP now, showing that they're seeing the GDP actually going up. That's the green line. And the forecast is anywhere from about 2.5% or so down to a little bit over zero, maybe 0.5%. So all of the forecasts right now on this chart are suggesting that we will have a positive GDP, which is not part of the recession definition. This chart makes a lot of assumptions, and you know what they say when you assume things. Depending on what the current level of CPI is, this is what they expect inflation to be. This red line along the bottom is what the Fed's trying to get back to at the 2% target. Another thing that we see a strong correlation with, when the dollar's going up, that's bad for emerging markets. When the dollar's going down, that's more beneficial for emerging markets. This light blue line is a ratio between developed markets and emerging markets, and it's been going up fairly strong lately, but the dollar's been going down. So we're seeing a little bit of a disconnect here. Will the dollar turn and go back up, or will this end up bringing the emerging markets ratio back down? We're keeping an eye on the dollar. We're right at a pretty significant support level. So far, on Friday and Monday, the dollar was up, and we're bouncing up off of this slightly. It's also a psychological level, since 100 is a pretty round number. Looking at Real Investment Advice and their blog post, here they have a chart showing the PPI to CPI spread. This orange line is when CPI is really going up. This gray area is when PPI ends up winning out and we're going down overall in the spread. And we saw PPI getting weaker than CPI right now. Will that eventually feed over into CPI? This looks at that same spread when we're above this, and blue, the spread is going up as far as inflation is concerned. When it's red and going down, that means that we're in a deflationary environment. This black line are the net margins or profits that companies have, and this is continuing to fall. If this ratio continues to fall, will that bring profits down with it? This looks at retail sales. It has some annotations on here. This is the nominal rate. Just what is it? Not taking inflation into account, just the raw number itself. Where retail sales are starting to come down on an inflation-adjusted basis, they also are really starting to come back down. Retail sales make up anywhere from 65 to 70% of the U.S. economy. So if retail sales are going down, chances the economy is running into some problem as well. So to see these declining is a little bit disconcerting. This is a tweet also posted by realinvestmentadvice.com, which they got from Twitter. It says the earnings outlook for S&P 500 earnings has taken a tumble. These black lines up here are what they thought they would be at the end of 2022. The blue lines are what they think they will be now. And you can see they're pretty much adjusting all of these blue lines to being less than what they were before if they're positive, and greater than what they were before if they are negative. FactSet came out with a recent post. The S&P will likely report a decline in earnings for the second consecutive quarter in the first quarter of 2023. The very first sentence says, as of today, the S&P 500 is reporting a year-over-year decline in earnings of minus 6.5% for the first quarter. Here's a chart showing how it's really dropping down over here. And then these surprises are still pretty high overall, but these are just what they think will happen going forward here. A couple of different charts I ran across. This is from Liz Ann Saunders, where it's showing for the first time since January where money is starting to flow back into banks. Then looking at our analysis, the Ulcer Index still suggests that we're very complacent, not a lot of fear. The VIX continues to fall with the line chart as well as the bar chart. The VIX of the VIX, which measures the volatility of the VIX, continues to decline both with the bar chart and the line chart. And then we're starting to get down a little too far too fast with the VIX. We're getting very complacent right now. Sometimes this can mark a top in the market. Now we could go down further with this RSI reading, but we want to know when it's in that area and we have dropped below 30. Here's a chart from Shavaco Capital just showing for 2022. This was the range of the VIX overall, and we're still getting very complacent as of current times. This is a new chart, a thing called the SKU Index, which I've been following for a while. I'm not sure if this is really telling us anything or not. The VIX is on the bottom, and that's hopefully pretty easy to understand. When it's going up, that means volatility is going up, and chances are the market's going down. Well, the VIX is measured with what's called at-the-money options. They have another index called the SKU Index where they look at out-of-the-money options to see what kind of a big swing do they expect. When this gets pretty low, that means they're not really expecting a lot of movement in the market. When we get up above 150 into this red area, that means they're expecting a pretty big move. Even though this has been coming back up, it's still not reaching these really high levels currently, but we'll keep an eye on this chart. I saw a tweet on Twitter also measuring this SKU index, and this person thinks we're going to just tank. On 417, the person said the market should be red tomorrow and significantly. This is ridiculous because this person sees the SKU index really going up, but it's not going back to really high levels overall. I did some research on this index. It doesn't have a really good track record for producing actionable information. How we really should use this is observable information and just add it to the other things that we're also looking at. The equity put call ratio hasn't really changed all that much after spiking up. It has been coming back down. It already gave some support to stocks, and it's not spiking up right now. If we start to fall back down, this will go back up. If we go up, this will continue to fall and possibly give more support to stocks. Looking at our fear gauge, we ticked up a little bit in Monday's session, but overall, we are continuing to show there's less fear, and we're also showing less fear with this other fear gauge that we look at. The high beta stocks still suggest that we're maintaining more of a risk-off posture. People are getting out of stocks and getting into bonds since bonds have more attractive yields now and are seen as less risky if you can lock in that yield. Looking at the condition of our trend, the red line is falling, so that could be taken as positive. But the green line is also falling. We're seeing the positive side of this actually start to decrease. However, on the bottom, the ADX continues to be above the moving average, so the trend is getting a little bit stronger, but we are still below 20 overall. The Arun is starting to go sideways now, but it's still looking positive with the oscillator above zero. Buyers are still in control as sellers continue to decrease. Here's the daily chart, and I tried to extend these lines over here. And please keep in mind that I draw these lines on here. They're not computer generated. It's not an exact science. But if we continue to go up with the S&P, we're hitting some previous resistance. We're also dealing with a previous high, and then we would also be dealing with the underside of this upward sloping trend line. All of these are starting to converge with each other and could produce some pretty significant overhead resistance. If we start to fall, we'll be looking at the 4100 level. After that, we're still above the 50 and 200 period moving averages, which may act as support if we do start to fall. On the bottom, you can see where volume continues to be well below average. On a short-term basis, our 20-period exponential moving average is starting to get extreme, but we're still seeing improvement with the 50 and 200. The CCI 14 period, which is our shorter term CCI, that's starting to get extreme. It's just barely above the 100 line. The slope is the only one of our oscillators that are starting to roll over. All of the other ones are positive. The PPO study still suggests long intermediate term we are positive. We're declining but still above zero in the short term. The Stochar SI is still extreme positive, as is the Williams percent R. Looking at our stochastics chart, and please keep in mind, this is a subdivision of the short term. All three of these charts are short-term charts, but we have short term on the top, and we're getting really extreme. Intermediate short term, we're also extreme, and we're getting even more extreme in the long short-term look at this chart. The force index continues to be positive. We're above all plotted moving averages, and we're starting to see these lines thin out a little bit and actually form some kind of a wave. The parabolic SAR is positive. The Swinland trading oscillator is positive, but we're starting to see a divergence here. With this movement up on lower than average volume, price has been going up okay, but we're flattening out based on volume. The vortex is still positive, even though the green line came down and the red line came up. The Sean trend meter is starting to look extreme positive. The Chaikin oscillator is turning back up. That is positive. The S&P to the utilities ratio is still not breaking out at all. And this is a warning sign that we've been watching now for about a week. Our PMO study shows that we're just getting extreme positive with the PMOs that are rising. We're still extreme positive with the buy signals, but we remain in an uptrend when looking at the percent of PMOs that are above zero. The BPI actually ticked down a little bit. It's hard to see. Not necessarily a concern right now, but just something that we will keep an eye on. And the NYSE bullish percent index is still just a little bit below 50. The Chaikin money flow really spiked up. The balance of power is ticking back up and is still positive. We're keeping an eye on these darker blue bars here. They're still positive, but not as positive as it had been. The go, no-go remains positive with blue bars, and we're above the anchored moving average from the all-time high, and these 50-period moving averages are starting to break out too. Here's a longer-term look. If we do start to fall, we're looking at the 4,074 level as support. Looking at our fib levels, we're still above the 4123 level. If we start to fall, we'll keep an eye on that level. Longer term, we have overhead resistance at 4156. And then even longer term, we have resistance at 4214, which is still a ways away. If we continue to fall, we'll be watching the 4020 level. Looking at our quadrant lines, also showing that we have pretty significant overhead resistance at about the 4170 or 80 level. And even if we break through that, there's still more resistance above current price. The equal weight, even though it improved, it's still underperforming the S&P 500. And this is also showing how the big stocks really spiked up and have still been maintaining a lot of their strength. The Elder Impulse system for the S&P is neutral. The McClellan oscillator turned back up and is not extreme. The broader range McClellan oscillator also ticked back up. That's positive. The summation index based on price and volume continued to advance. That's positive. We're seeing a little bit of a negative divergence here where the S&P has been able to break out above this blue line, but the NASDAQ has not been able to do so, and we're watching this as a potential short to intermediate term double top. The transports continue to underperform the Dow. That's a warning sign. New highs, new lows. We did see an expansion of new highs, but our moving average continues to roll over, and we're flat with the 10-period moving average. We're still seeing a negative divergence with the advanced decline line, breaking out with price, but not breaking out with volume. Here's the NYSE advanced decline line, which still is holding up fairly well. And this just looks at the common stock advanced decline line for the NYSE, where we made a higher low earlier in 2023, but we made a lower low when you compare it to volume. That could be a longer term negative divergence. The advanced decline ratio is still positive with both lines above zero and advancing. Accumulation distribution remains positive. Volume continues to drop off. The money flow continues to be positive. The ultimate oscillator is also positive. On-balance volume is still positive. The financial sector is bouncing back a little bit, but still had a recent death cross with the ratio compared to the S&P. The regional banking ETF did bounce up a little bit, but is still in a pretty solid downtrend when compared to the financial sector. Looking at our broad range of the NYSE, we're above the moving average. With the S&P, we're also above mid-caps, but small caps continue to lag, and this is a warning sign. The Dow is still having a hard time breaking through this R1 pivot level. The diamonds remain neutral. The NASDAQ also has not broke out yet. We're watching this potential double top here. I shouldn't say potential double top. It is a double top. It's just, is it going to be a problem for current price? The NASDAQ did break above this previous top, but it's been chopping sideways as of late. The Qs remain neutral, and we're still above this 12,864, 38.2% retracement level. If we fall, we'll be watching that level. And I had been showing a weekly chart of the Qs, which are based on the NASDAQ 100, how we were not able to break through this anchored moving average going back to the all-time high. We were able to break through it, but we're just kind of stalling out sideways right now. The microcaps had a pretty good day, up over 2%, and are still above their 52-week low. The small caps still having trouble getting back up to its 200-day moving average. Here's the Russell Small Cap Index. We're above 50 and advancing. That's positive. The MACD is still positive, but we still have pretty significant overhead resistance. The small caps have switched back to positive for the Elders Impulse system. The small caps continue to underperform the S&P 500. The mid-caps are dancing just around this pivot level now. They're above their 200-day moving average, but remain below the 50-period moving average. The mid-caps have now switched back to positive for the Elders Impulse system. Here's the Home Builders ETF, where we've been going up with the S&P. The Home Builders ETF has been going up, but not as much. And so we're seeing a real breakdown in this ratio overall, which was picked up by the correlation, and that gave us this extreme negative reading. Now we've worked our way back to the Home Builders and S&P having a really strong correlated relationship. The fact that this is really lagging behind, will that add some pressure to the S&P 500? The Copic curve is on a buy signal, but it's starting to get weaker. And the Pring Bottom Fisher also gave us a recent buy signal, and that's also beginning to roll over. Bond yields were up. Bond prices were down. Here's another chart that I showed over the weekend. This is the MOVE index on top, which is the VIX for bonds. And then we have the VIX down below measuring volatility. And you can see at the bottom, there's a really strong correlation between the two of them. But right now, we're not getting a real extreme reading with the MOVE index, even though the VIX is really in a complacent state. The long-term trend continues to hold up with the MACD above zero and advancing, suggesting that this breakout above the trend line was for real. An update of our possible positive scenarios. The 10-day average of the S&P highs minus the lows is still looking extreme positive. You could take that as positive since we can camp out in this area for a while, or this may be contributing to the overbought condition. The ZWAG NYSE breadth thrust did give us a signal, and it's still active now going forward. And these are the returns that you can see going out 1, 3, 6, and 12 months. Looking at the broad range of the highs minus the lows and then taking a 5-period moving average of that, we still remain below zero. Looking at our ratios, the Qs actually underperformed the S&P, where discretionary showed a little bit of improvement, and we're rolling over a bit with large cap growth. Our growth to value ratios, the large cap rolling over a bit, little bit of improvement with the mid caps, and just about on the moving average with the small caps. Our 50-day exponential moving average of the new highs minus the lows, we're still above zero, so longer term that is positive, and our indicator is still above zero, that is positive. The 2-year treasury yield, after spiking up and coming back down, gave some support to stocks. If it continues to fall, will that give more support to stocks? And our staples to S&P 500 ratio, after giving these two little spikes here, we're coming back down slightly. We're wondering, is that a valid spike? So what's our outlook for Tuesday? Earnings season is now underway. The technicals are positive, but we slip back to being more overbought. We have housing starts and building permits that will be coming out, and these tend to be leading indicators since you have to do all this stuff before you can actually build a house. And then the whole list of geopolitical events with inflation and interest rates being at the top of the list for the stock market. Also worried about this banking situation. As far as Fed speak for Tuesday, we do have one speech given by Governor Bowman. Then on Thursday, there will be two speeches, one given by Governor Waller and the other one by Governor Bowman. And then there'll be another speech on Friday by Governor Lisa Cook. Looking at our Stock Traders Almanac statistics, we tend to be positive throughout the month of April overall. But looking at April 18th, the Dow is neutral to positive, being up 61.9% of the time, as well as the S&P. The Nasdaq is not as positive, where it's more neutral, being up 52.4% of the time, whereas April tends to be a positive month overall. Then this next chart is just adding to our yearly positive backdrop. And here is the chart showing the green area, which is producing positive seasonality. Here's the gray line, also positive seasonality, and the other green line, also positive seasonality. We're on the 12th trading day of the month, where we see a little bit of a decline in a pre-election year with the S&P. Our scenarios. Can't really go with the down one, even though there's a lot of negative things happening. Our technicals are positive. The charts are still pointing up, but we are overbought yet again. Hard to go with the up one because we're overbought, even though there are some positive things in the background. We're tending to lean more towards sideways to neutral trending right now because our ADX is strengthening. It's above its moving average, but it's still below 20. We are defaulting to the positive side, but the green line is declining. Warning signs. Volume remains below average. The S&P is now back to being overbought. The VIX is showing complacency. The S&P is underperforming utilities. The new highs, new lows continue to lag. We're still in a risk-off posture, meaning that folks are favoring bonds over stocks. Small caps continue to underperform. The Nasdaq may be declining from a double top. The home builders' negative divergence is still there, even though we're passed by that major signal. Now we're seeing how things play out going forward. And earnings season is underway, which could be positive or it could also be negative. Folks could also be buy the rumor, sell the news. That's a common theme that you see in the month of April. Our conclusion, the S&P is positive but overbought. We're overbought in the short and intermediate term, and we're positive in the long term as long as we're above the 200-day simple moving average, and we've had a recent golden cross. Thank you. I hope you found this video helpful. I want to welcome all the new subscribers. Had a lot of folks joining the channel and starting to watch the videos. I really appreciate that, and I hope you find these videos very helpful to what you're doing. I hope you have a really good day, and I will talk to you in the next video.